Fine. So the streaming is on. OBS Studio is start virtual camera, start recording. Microsoft, has anyone joined? Let's see. Hello, Rakesh, are you able to see the PPT and hear me out also? Perfect, thanks. So we'll begin, and today a new session and a new chapter. So as my style has been of the session taking to cover the study material entirely, and that's what has been told by the institute also, that the reference material will be again the study material of the Institute of Cost and Works Accountant or Cost Accountants of India. And with that we are on to the paper 20A, that is strategic performance management and business valuations. So Anu, welcome. Are you able to see the PPT and hear me also?
Yes, sir.
Perfect. Okay. So it's 20A paper, which is about strategic performance management and business valuations, and we are on the section B, module 5, fundamentals of business valuations, wherein first of all this entire module is more of a creating a background why exactly the valuation is required and how the valuation is to be done, etc. What are the approaches? So we finished with the purpose of why business valuation at all is required to be done. Thereafter, what sort of valuation premise or the background of valuation is, and then the various valuation approaches that we covered in the previous session. Three approaches typically: market approach, income approach and cost approach. So accordingly each approach has its own methods, or more than one method. We saw how the methods, according to that the calculation is to be done. A major part of the valuation or the component of valuation is what we will be covering. So fundamentals of valuation in terms of what is meant by risk and return. So let's begin. So as a critical component of valuation, along with the various financial metrics, the risk involved in a particular business or the operations per se, and the returns that are expected from that particular business, those aspects are critical, and hence they are referred to as fundamentals of valuation. So we'll see how risk and return obviously both go hand in hand, or at times they are directly proportional, or at times they are inversely proportional also. So higher the risk, higher the return, depending on again what you can say, the financial instrument or the purpose with which the money is being deployed, because it's all about finance, and hence whatever financial decisions one takes has the impact or has the key drivers, that is the risk involved and the returns that are going to be gained out of the financial decisions that have been taken. So 7:30 ला द्या नेहमी सारखं. थँक्स. दादा खिडक्या लावा ना जरा, ते डास पण येतात कोणीतरी. Sorry. Yeah. So Harry Markowitz was the expert who propagated or promoted modern portfolio theory. And in that he was the first to quantify risk and use it in the portfolio decision making. So considering the risk factor and the return factors, in a way, Markowitz highlighted the impact of risk and return on the investment decisions, and accordingly he came up with a modern portfolio theory. So every portfolio management has to factor into risks and returns also at the same time. So with that, so he was the first to quantify the risk and use it in the portfolio decision making. Now when we say portfolio decision making, typically it's about the investment portfolio that a investor has to think about, and while deciding that a particular portfolio, one has to keep in mind the risk and the returns, or the risk or the rewards which are being thought of and probably possible in a particular investment decision. So that's, for the first time he quantified the risk and used it in the portfolio decision making. So to counter the risk and to achieve the return objectives, how the portfolio of investment should be diversified, etc., that was possible thereafter only when he started quantifying the risk. So he suggested identifying an optimal portfolio based on the risk return criteria. So sorry, I am having my cup of tea, evening cup of tea. So while doing so and deciding the risk return criteria, the assumptions that were there were investors are risk averse, obviously. No one will be risk free and careless about the risk also. And hence investors are risk averse. Investors prefer higher wealth due to greater consumption possibilities. So that's another assumption which he had, or his theory has. The third assumption, given two portfolios with similar risks, the one with higher return is preferred. So our return is always preferred over risk, and these assumptions are central to investment valuation. So that's how the assumptions were. These are the assumptions typically which he, just a second. So these are the assumptions which are propagated in the modern portfolio theory and are the core to the investment valuation per se. Moving ahead comes the return. So return can be realized or expected. Rate of return formula, which was propagated in the modern theory, modern portfolio MPD, which is called as short, is rate of return is equal to income or the cash flows, that is DT, plus PT minus P into bracket T minus 1 divided by PT minus 1. So where R is the rate of return, PT is the price during holding period, PT minus 1 is the purchase price, and DT is the income divided by cash flows. So expected return is equal to weighted average of probable returns. So that's what the return formula in MPT is. Third factor, which is the risk, he defined as the chance of deviation from the expected return. So risk is nothing but whatever expected return has been there, and if that expected return is not met, then to that extent what has not been met is the risk element which he in a way defined. So it is a chance of deviation from expected return. Higher risk leads to higher expected return. So that's what directly proportional. And that risk is measured using standard deviation as a statistical tool. More volatile assets have higher risk because there is more churning of buy and sell that is happening in that particular asset, and therefore there is always a probability of higher risk in such volatile assets. So therefore he proposed diversification of risk. So risk can be reduced by investing in multiple securities. So that's what his modern portfolio theory was all about. Risk diversification. So in a way, risk, which is a deviation from the expected return, can be reduced by investing in multiple securities rather than one. And that's how diversification of risk can be achieved. So if at all a particular script goes wrong, the other security performance will counter the poor performance or the wrong performance that happened in case of one of the securities. So that's what the diversification is. Risk can be reduced by investing in multiple securities rather than one. An efficient market allows risk-averse investors to secure investments through diversification. So whole intent over here is, because the investor predominantly is risk-averse, in a way risk diversification enables the such risk-averse investors to venture or take a courage to enter into the capital markets or financial markets. And therefore an efficient market allows risk-averse investors to secure investments through diversification. The diversified portfolios includes equities, bonds, real estate, savings accounts and bullion, etc. So all the multi-allocation assets can be done, and these assets typically will be the financial assets which are either tradable in the market or non-tradable in the market. The tradability of course brings the liquidity aspect over here, and hence the risk can be in a way mitigated. But even if a particular security is not tradable per se in a free market, still it has its own importance in diversification of the portfolio. So correlation, that is R among investments, affects the diversification benefits. Then typically he propagated the types of risks associated with a particular investment decision. Of course, it depends on the nature of the investment or the investable securities or investment security. So first is the interest rate risk. So due to changes in interest rate, there are chances of loss, or what you can say, interest is a cost on that security, and hence because of the fluctuation in the rates of interest, there could be a risk of loss of return or reduction in the return. So let's assume interest rate risk. For example, today I am investing and the interest rate of the banks, because which are dependent on the rates declared by the RBI. Accordingly, currently the bank rates are, let's assume, at the rate of 8% the fixed deposits investments are available on bank deposits. However, because of certain economic decisions at today's juncture, if I am investing 1 lakh rupees, what rate of interest that the investor will be getting is 8% on these 1 lakhs. However, at a later point in time, let's assume the economic conditions in a way were conducive, and RBI decides to amends the rates or brings the rate changes, and because of those rate changes, banks decide to upscale the rate of interest on the fixed deposits, and then it's a hypothetical example obviously, and the rate gets fixed for 9%. So to that extent, because my timing has gone wrong in the sense, the rate of interest was prevailing at that point in time was 8 and now it's 9. So in a way I carried a risk of 1% reduction, but this 1% carried risk reduction was not envisageable or anticipable or was not anticipatory at the time of investment also, but over a period of time the trends and the expertise can be gained as to how to read the economic conditions around and expect some kind of a trend in the interest rate in the coming future. So that interest rate risk can be in a way mitigated basis the various forecasting mechanisms and keeping a track of the economic conditions, domestic as well as international also. So this is one type of risk, that is the interest rate risk. Market risk due to fluctuations in the securities market, the sentiments, the fear factor, the greed factor, the need factor, etc. Obviously the demand supply forces will fetch the suitable price, or the price determination will happen of the securities market according to the demand and supply, and therefore there is a market risk of fluctuation in the prices. Then comes the inflation risk, again due to changes in the general price levels of the economy. That risk has an impact on the investments. Business risk due to firm specific activities, the investment may go wrong, or there is a risk factor associated because of certain changes in the firm's activity, specific activities. Another type of risk is the financial risk. So due to presence of debt in capital structure, there could be some kind of a financial risk because it's an obligation which has been incurred or taken by the corporate or the business organization, and in that case there is always a risk, financial risk associated with the obligation, that the obligation may not get fulfilled or may not get repaid back, and hence there is this financial risk which is because of the presence of debt in the capital structure. So because of the capital structure mix, debt and equity, if the debt is more than the equity, then there is some element of financial risk which is involved. Then comes the liquidity risk. Liquidity risk is due to trading conditions in secondary market. So in a way, because of the easy liquidation of the various financial securities, the ease of trading at times will have an impact on the price determination, which are determined by the market forces of demand and supply, and hence easy encashing of the security at times create a imbalance in the market demand and supply balance, and therefore market prices may get impacted. So there is this liquidity risk, in short, due to trading conditions in the secondary market. Then comes the systematic risk, which systematic risk is such kind of a risk which cannot be diversified. So non-diversifiable risk is another category of risk which affects entire market and cannot be eliminated. So formula for systematic risk is beta raised to 2 into standard deviation raised to 2m. So that's how the systematic risk can be calculated. Unsystematic risk is diversifiable risk, where from specific risk that can be reduced. So formula for unsystematic risk is total risk minus systematic risk. Now let's understand what is meant by beta. So these are the fundamentals of risk and return that we are understanding. Now beta is a measurement of systematic risk, that is a market related risk, and typically the symbolic way it is this kind of a B, which is representing beta. So it indicates stock sensitivity to market changes. So how sensitive a particular stock is to the various market changes that are happening around that particular stock or the industry or the sector also. So beta of overall market is assumed to be or is normally considered as 1, and formula for beta is the covariance of stock and market divided by the variance of market. Example, A Limited, beta is 0.6035, meaning it is 40% less volatile than the S&P 500. So Standards and Poor 500 index, and hence vis-a-vis the index, when beta of a particular company is say 0.6035, it means that it's 40% less volatile than the S&P index or S&P 500 index. That's what beta means. So covariance of stock and market vis-a-vis the variance of market. Limitations of beta. Obviously there are certain limitations of beta because it is based on, one is that it is based on historical values and it tends to move towards market industry beta over time. So these are the limitations. So frankly, if you see the entire chapter, it is just a 2-pager, 3-pager chapter of fundamentals of, in a way, valuation per se. Just a second. I need to do this because otherwise, the entire PPT will go wrong. Give me 2 minutes while I am just making this change. In this copy pasting business, the header didn't get, or I forgot to change the header. So as I said, it is just a 2-pager, 3-pager chapter where risk and returns are discussed in this fundamentals of valuation, and therefore in a way the theory part is over. However, as I said, and the approach that I have taken, when you refer to the short question and answer of the which are there at the bottom of the or at the end of the chapter per se, these short question and answer as well as long question and answer and has an underlying concept which is discussed and which needs to be discussed, and hence by addressing to those long Q&A and short Q&A, I am trying to cover the concept as such of those question and answer, so that you will be able to answer the questions in your examinations also well, if at all they get repeated, or else the concept per se based certain questions come in the examination. So I thought the better way to cover the concept than in the that has been given in the short Q&A as well as the long Q&A after the chapter. So give me 2 minutes, I am just cleaning this error which is there, that the PPT is perfect. So in a way the per se the chapter is over. However, the various concepts that are essential to be understood for risk and return by way of short and long question answer, I will try to explain that out in this session itself. So which otherwise also that I have been doing this in each and every session, taking up the questions. So after the chapter, typically if you see the study material, there are MCQs which I am not taking up because it's there explained out in the study material. So that's what Yeah, so we finished with the limitations of beta, and now moving ahead to the short question and answer. So question number one, the short question and answer one deals with the Markowitz modern portfolio theory. So in a way I am covering the portfolio theory over here, which is not there per se in this chapter in the study material content of this chapter, but by understanding the short question and answer one, I'll try to help you out and cover the Markowitz modern theory, portfolio theory, more structured way. So objective of this theory is to minimize the risk while maximizing returns through diversification. The assumptions are there: investors are risk averse and investors prefer higher wealth. Risk return trade-off. So it's a classic feature of this theory. It's a risk return trade-off. It helps identify optimal portfolio combinations. It aims to maximize the return for a given risk or minimize risk for a given return. So that's how the relationship between risk and return trade-off is established out over here. So that's the aim of this theory, to maximize the return for a given risk or minimize the risk for a given return. So the diversification principle per se of investment is that investing in multiple assets reduces the overall risk, and correlation between assets affects the diversification benefits. So the whole intent of this modern portfolio theory or MPT is decision making. It helps investors choose the best portfolio mix and focuses on balancing risk and expected returns efficiently. So in a way, short question and answer one has dealt with Markowitz modern portfolio theory. Then comes the question number two of short question and answer two. So that short question and answer two has dealt with the types and role of risk in investment decision making. Whether risk has at all any role in investment decision making. Yes, of course there is a big role that the risk plays in or contributes to the investment decisions. So let's understand the type of risks, and then we'll see what sort of role do they play. So types of risk involved are the interest rate risk. So impact of changing interest rate on investment value. Market risk is the overall market fluctuations affecting the investments. Inflation risk is reduced purchasing power due to rising prices. So that's what inflation is all about, that the purchasing power reduces and therefore reduces due to rising prices, because normally the investor is then hours of buying because of the inflation. Business risk, company specific risks affecting the profitability. Financial risk, debt related risk impacting a firm's financial health. Liquidity risk is the difficulty in converting investments into cash. Systematic risk is the market wide risk that cannot be diversified away, and in a way non-diversifiable risk, which is a systematic risk. And unsystematic risk is the company or industry specific risk that can be reused. So unsystematic risk is the diversifiable risk and systematic risk is the non-diversifiable risk. So these are the types of risks. So if you have to remember how many risk types of 1, 2, 3, 4, 5, 6, 7, 8. So 8 types of risks are there. Role of risk in investment decision making. It helps investors assess potential returns and losses. It influences asset allocation and portfolio diversification, and determines risk tolerance and investment horizon. So this is therefore, as I said, risk plays a very critical role in the overall investment decision making and portfolio management. Then let's see the risk reduction strategy. So how do we mitigate this risk? Because as we know, risk plays a big role in investment decision, and therefore there has to be some mechanism around to have a control or mitigation strategies for the various 8 types of risks that are there. So the risk reduction strategies involves diversification. That's the key of the modern portfolio theory. So spreading investments across different securities and industries to minimize the unsystematic risk. So what is the unsystematic risk? Company or industry specific risks that can be reduced. So this is what the unsystematic risk can be in a way mitigated or reduced by way of a diversification. Then comes the asset allocation strategy. So in asset allocation, it's basically the balancing of different asset classes to reduce the exposure. So these are the strategies how risk can be mitigated while taking investment decisions. So hedging strategies using derivatives like options and futures to mitigate risk. So these are the derivative instruments which have got developed over the period of time in the capital markets, and typically the derivatives are considered to be hedging instruments for the risk. So hedging strategies using derivatives like options and futures to mitigate the risk. And the fourth strategy of risk reduction is obviously research and analysis per se. So assessing market trends and financial health before investing. So then now let's see the short question and answer number 3, which deals with beta calculation. So how beta is to be calculated, a small problem has been given in the study material. So the formula which is of beta is the correlation into stock standard deviation divided by the market's standard deviation. So given data is correlation between stock and the market. S&P 500 is 0.08. So stock's standard deviation is 0.1, and S&P's 500's standard deviation is 0.15. So the calculation is beta, that is correlation. So correlation over here is 0.8. 0.8 into stocks, individual stock standard deviation, which is 0.1, divided by the market standard deviation. Now market over here is the S&P 500's standard deviation, that is 0.15. So 0.1 divided by 0.15. So 0.8 into bracket 0.1 divided by 0.15 is what the beta is. So beta is in a way 0.53. So the interpretation wise, what is meant by beta 0.53 means a beta is 0.53, indicates that the stock is less volatile than the market, that is S&P 500. So it's a comparison of beta. Beta is a comparison of an individual stock with respect to the market fluctuation. So how market is performing vis-a-vis how a particular stock is performing. So that kind of a correlation is being established between the stock standard deviation and market standard deviation. So that's what the beta calculation is normally done. So in examination some kind of a problem you can expect, and in that case this is how the beta calculation should be done, and the interpretation of a particular beta in this particular case is 0.53, which indicates that the stock is less volatile than the market S&P 500. In question number 4, short question and answer 4, the another concept which has been dealt with is about the realized and expected returns. So realized returns, let's understand. So realized returns are the actual returns received by an investor during the holding period. So actually encashed return in a way, realized means received. So actual return received by an investor during the holding period. Expected return is the projected return an investor anticipates from an investment in the future. So what expectations a particular investor is holding in terms of the returns over a future period of time, that's what is expected return. The general equation for rate of return is R is equal to dt, that is the dividends received during the period, minus plus into bracket pt, that is pt is the price at the end of the period, minus pt minus 1, that is the price at the beginning of the period, divided by the price at the beginning of the period. So that's how the rate of return is calculated uh, normally, where R is the rate of return in this formula and dt is the dividends received during the period. Because it's about rate of return of on equity, that's why dividends as a projected return or a actual return. Dividends are the return on investments in shares. That's why dividend received, actual received during the period is being considered and divided by the price at the end of the period, and the price at PT minus 1 is the price at the beginning of the period. So this is the general equation for rate of return. Now let's see the question number 5, short question and answer 5, which deals with again Markowitz portfolio theory, assumptions and relevance. So how portfolio theory, modern portfolio theory of Markowitz is relevant and what sort of assumptions are being considered in this MPT. So the key assumptions involved are that investors are risk averse. They prefer lower risk for a given level of return. Second assumption is investors seek wealth maximization. Higher returns are always preferred. So if at all there are two portfolios or two securities, amongst the two securities, whatever higher return is being expected, that security will be, investment will be done in that security. So higher returns are always preferred. Asset returns follow a normal distribution, so helps in risk modeling. Investors base decisions on expected return and risk variance. So mean variance optimization is the assumption over here, and no transaction cost or market frictions is the another last assumption that has been considered. So in a way, idealized market conditions where there is no transaction cost and there are no market frictions also. So it's an ideal situation of a market condition which never exists, but it is assumed in modern portfolio theory. So in short, these are the key assumptions. Let's see the relevance of these MPT. So these assumptions guide portfolio optimization along the risk return trade-off. They help in diversification strategies to minimize the risk. Though idealized, they provide a foundational framework for modern investment analysis. So these assumptions in a way has necessary relevance by guiding portfolio optimization, helping in diversification strategies, and thereafter giving a foundational framework for modern investment analysis. Now let's look into the question and answer number 6. Volatility as a measure of risk is the concept that is being dealt in this short question and answer 6. So volatility, how volatile is a particular investment, that is the measurement of risk. Sorry, just a second. Hello. Yeah. मॅडम मी जरा आता लेक्चर घेतो आहे, उद्या बोलू शकतो का आपण? प्लीज प्लीज, थँक्स. Sorry. So volatility is the measurement of risk. Definition wise, what is volatility? It represents the degree of price fluctuation, as we know volatile, over time in a trading series. So that's what the fluctuations which are there in the prices during a particular trading session, that is so over a period of time is the volatility. So too much of buying and selling, how the buying and selling vehemently is happening, that is what is volatility. The role in this measurement, typically higher volatility indicates greater uncertainty and risk. So for such volatility, standard deviation in measuring risk. So standard deviation quantifies the dispersion of returns from the mean. How much dispersion has happened of the returns from the mean return is what the standard deviation in measuring risk. So formula wise, its standard deviation is equal to square root of the summation of Ri minus R dash raised to 2 divided by n. So standard deviation, individual return, then the mean return. So how much deviation or dispersion has happened is Ri minus R and divided by the number of observations that have been considered to arrive at a particular deviation, or the mean also for that matter. So typically these are the statistical formula which are used for in the portfolio management and investment decisions. So depending on what the answer would be, or in terms of numeric, interpretation wise, higher the standard deviation means higher volatility, higher the risk, and lower standard deviation means more stable returns and therefore lower risk. And accordingly, volatility therefore can be measured in terms of how much volatile it is vis-a-vis the mean returns. And therefore higher standard deviation, if at all is there, means higher volatility is there, too much of buying selling is there, maybe it reflects uncertainty about the mindset of the market, and therefore there are chances of higher risk. And lower standard deviation means not much of volatility is there, lower volatility, therefore more stable returns are possible, and hence there is a lower risk. So that's how volatility as a measurement of risk is considered and discussed in short question and answer 6. Then comes the question and answer 7. In that question and answer 7, the underlying concept that has been discussed is about the importance and limitations of beta in investment decisions. So let's understand the importance of beta per se. It measures systematic risk, indicates a stock's volatility related to the market. So how a particular scrip or a stock or a security is volatile vis-a-vis the overall market trend of volatility. That's what it measures systematic risk. Then it guides investment decisions. So the importance of beta, which is a measure of systematic risk, is that it measures systematic risk, that's itself, and secondly it guides investment decisions. So in a way it helps investors assess the risk exposure. Then beta is used in CAPM. So CAPM is the capital asset pricing model. So over here it determines expected returns based on the market risk. And fourth importance of beta is that it helps in portfolio diversification. So it assists in balancing the high and low beta assets. Then comes the limitations of beta. Of course, like any other measurability, beta, which is a measurement of systematic risk, and systematic risk is the relationship of a particular stock volatility with vis-a-vis the market trend, has its own limitations also. The first and foremost limitation is the historical dependence. So it is based on past data, may not predict future risk accurately. That's the limitation of this beta. Market sensitivity, so beta tends to converge towards 1 over time. It ignores specific risk, only measures market related risk, not firm specific factors. And fourth limitation is it fails in extreme market conditions. So unreliable during financial crisis or black swan events. So black swan events is the trend which happened in financial crisis. Of course, these are not routine financial crisis. So in such situations, the market cannot really be predicted, and one has to live with it when there are certain extreme market conditions. The last short question and answer, that is number 8, deals with portfolio selection in Markowitz theory. So the decision rule over there in that question is that choose the portfolio with the higher expected return if risk levels are the same. So if the risk is same, while deciding the components of portfolio, then always go for the higher expected return if the risk levels are same. And the reasoning out over here for portfolio selection, if there are risk levels which are same, then go for the higher expected reasoning. Risk return trade-off always plays. Just a second. So risk return trade-off, higher return is preferable for the same risk. Between the two, obviously, if the risk is same, go for the higher return, because in a way you go with the trade-off principle between risk and return. Investor behavior. So here it's assumed that investors are risk averse and they always seek wealth maximization. And third reasoning is that efficient frontier concept. So efficient frontier concept is that optimal portfolio maximize returns for a given risk level. Sorry. So optimal portfolios maximize returns for a given risk level. So that's called as efficient frontier risk concept. So in conclusion, a rational investor will always prefer the higher return portfolio when risk is constant. As simple as that. So this is how portfolio selection is done in Markowitz theory. Now let's look into the long question and answer which have been given in the study material at the end of the chapter. So question number 1, long question and answer 1, deals with systematic and unsystematic risk. So let's understand systematic risk. So definition wise, systematic risk is risk that affects the entire market and cannot be diversified away. So this is something which cannot be controlled in a way. It is caused because of the macroeconomic factors like inflation, interest rates, recession and geopolitical events. Example wise, a global financial crisis affecting all stocks. Second example could be interest rate hikes impacting the bond and equity markets. And third, as the entire world saw, was a pandemic disrupting the entire global economies. So these are the systematic risks, and therefore they are also called as non-diversifiable risks. So just a second. So there is no way that this risk can be diversified. So that's what it means, non-diversifiable risks. So certain factors which are beyond control or beyond diversification, and because of which there is a risk element in the investment, then they are called as systematic risks. Then let's look into the difference between the systematic and systematic risk. So unsystematic risk is definition wise firm specific risk that can be reduced through diversification. So it's about the risk about that particular entity or the strike or the security associated to a particular firm, and that's why the various risks associated to a particular firm or company, that particular firm specific risk can be reduced through diversification. Now the causes of such unsystematic risk, let me just, so these are diversifiable or so definition, firm specific risk that can be reduced through diversification. The causes of such risk are the internal business factors like management decisions, product recalls or labor strikes, because these are firm specific causes on systematic risk. Example, a company CEO resigning and therefore leading to stock volatility, or a product failure causing financial losses for a firm, or a factory shutdown due to a worker strike. So these are certain causes which are controllable by the firm also at times, and therefore they are firm specific, and therefore unsystematic risk is always firm specific, and there it can be reduced through diversification. So in terms of key difference which is dealt in long question and answer, one of systematic and versus unsystematic risk is, systematic risk is market wide, non-diversifiable, and unsystematic risk is company or industry specific and therefore diversifiable. So these are the key differences between the two risks. In long question and answer 2, then the concept which has been dealt with is the diversification and its role in risk reduction. So how diversification per se as a risk reduction strategy is effective, that has been dealt in this long question and answer 2. So let me explain what is meant by diversification theory, which is a risk reduction strategy. So definition wise, it's spreading investments across multiple assets to reduce the overall risk. Objective of this is to minimize the impact of individual asset fluctuations on portfolio performance. So objective of this diversification theory, which is the crux of modern portfolio theory, is to spread the investments across the multiple assets to reduce the overall risk of the investment amount. Impact of correlation on risk reduction. So how correlation impacts the risk reduction? Correlation measures from -1 to +1, so that's the range of correlation. So perfect positive correlation, that is +1, is no risk reduction, asset moves together. So in a way there is no trade-off or no risk reduction per se, and therefore assets are moving in a particular direction altogether itself. So that's +1. When the correlation is +1, it means that there is no risk reduction and the assets are moving together. The perfect negative correlation, that is -1, is the maximum risk reduction, assets move in opposite directions. So that's what is meant by correlation, impact of correlation on the risk reduction. Low or zero correlation means it provides optimal diversification benefits. So it's like the ultimate ideal state where when the correlation is low or zero. Key insight from correlation that one gains is that combining assets with low or negative correlation reduces the portfolio volatility. So that's what the insights are helpful in decision making for a particular portfolio management. So that's what the whole portfolio theory is all about. Again, the application in investment portfolios of this diversification are the diversification benefits are that it lowers unsystematic risk, that is the firm specific risk, creates a more stable return profile, does not eliminate systematic risk per se, which are the market wide risk. Example, a portfolio with stocks, bonds and commodities reduces overall volatility compared to holding only stocks. Conclusion wise, effective diversification requires assets with low correlation and helps investors achieve better risk adjusted returns. Then in long question and answer 3, the concept that has been dealt with is the calculation of expected return and standard deviation. So expected return calculation, this is the formula where PI is the probability of each outcome, RI is the return of each outcome. Given returns 12%, 8%, 14%, probabilities are 0.3, 0.5 and 0.2. In that scenario, the expected return will be 10.4%, and that's how the formula is calculated. The covariance and standard deviation calculation includes formula for variance, which is standard deviation, square of standard deviation, and the summation of or sigma of pi into Ri minus expected return raised to power 2. So step 1 in terms of computing deviations from expected return are 10.4%. So 12% and 10.4% is equal to 1.6%. 8% of 10.4% is 2.4% and 14% of 10.4% is 3.6%. Step 2 would be square the deviations. So squaring these deviations would be 0.0256, 0.0576 and 0.1296. Then in step 3, multiply squared deviations by probabilities. So this is how the calculation will be done in terms of the probabilities that are there. So 0.3 into 0.0256 plus 0.5 into 0.0576 plus 0.2 into 0.1296. So the probability over here is given. So 0.3, 0.5, 0.2. So accordingly the standard deviation are multiplied with the squared deviations are multiplied with the probabilities. And just a second. Third is multiply the squared deviations by probabilities. I am just structuring it a bit so as to make it more understandable. And in step 4, compute standard deviation. So standard deviation is equal to square root of the 0.0624, which is arrived in step 3. And that comes to 7.9%. So in a way, final answers are the expected return, which is 10.4%. So over here it is given, and the standard deviation is 7.9%. So this is how calculation of expected return and standard deviation is done. So that's what has been dealt in the, just a second. So in long question and answer 3, the calculation of expected return and standard deviation has been discussed. In question number 4, long question and answer 4, the underlying concept that is discussed is about portfolio expected return and risk calculation. So the formula for portfolio expected return The definition wise, the expected return of a portfolio is the weighted sum of the expected returns of individual assets. So this is a formula where ERP is the portfolio's expected returns, WI is the weight of each asset in the portfolio, and ERI is the expected return of individual assets. So formula of portfolio risk again is calculated by way of, that is the standard deviation, where 2 asset portfolio formula is used, and then third will be role of beta in portfolio risk. So beta measures systematic risk, that is market related risk of an asset. It helps in evaluating portfolio exposure to market movements and used in capital asset pricing model to estimate expected return. So in a way, concluding, the relationship of portfolio expected return and risk calculation is that portfolio return is the weighted average of individual asset returns. Portfolio risk depends on the asset correlations and variances, and beta helps measure market risk exposure and is crucial for risk adjusted return analysis. Then let's look into the question and answer 5. So there is underlying evaluation of a statement which has been done in long question and answer 5, which is an investor should not keep all eggs in one basket. So this is a famous maxim that is used in investment decision making and investment portfolio management, etc. That never put all your eggs in one basket, because if at all one egg gets broken, the rest of the eggs will also get broken. So that's what the logic of risk diversification is all about. Meaning of the statement means suggests diversification to reduce risk in investments. It avoids over concentration in a single asset or asset class. Implications in portfolio construction, so risk reduction, so spreading investment across assets minimizes the unsystematic risk, that is firm specific risk, and lowers portfolio volatility by balancing the gains and losses. Impact of correlation over here is that diversification works best when assets have low or negative correlation. For example, stocks and bonds often move inversely, thereby reducing portfolio fluctuations. So this is how the balancing act is done when such kind of diversified portfolio decisions are taken in your investment planning or investment structuring. So that's what the whole maxim is all about. An investor should not keep all eggs in one basket. Continue with the same, enhancing risk adjusted returns. So it helps stabilize the returns over the period of time. Investors achieve better risk adjusted performance rather than chasing high risk assets. Limitations of over diversification of course are there. Diminishing returns, too many assets can dilute. So over diversification is also at times risky and harmful, and hence there should be always a balancing act in diversification. It's an art. So diminishing returns, too many assets can dilute high performing assets or high performing investments. Management complexity, so more assets require increased tracking and analysis, and systematic risk still exists. So irrespective of how strongly diversification or over diversification is done, the systematic risk will always exist. That is, the market wide risk cannot be diversified at all. So in a way, concluding, diversification is essential but should be strategic investing in negatively or weakly correlated assets, and balanced portfolio construction ensures both risk minimization and return optimization. So that's how the dictum or the maxim of evaluation of the statement an investor should not keep all eggs in one basket is all about. Then question and answer 6, which deals with risk adjusted portfolio for risk averse investor. So how risk adjusted portfolio should be devised and framed for a risk averse investor. Let's see. So portfolio composition should be low risk and diversified allocation. because this investor is risk averse and therefore low risk should be always maintained and diversification allocation of should be done. So government bonds 40% around of the entire 100% investment amount, hedge against market risk and ensure stable returns. Blue chip dividend stocks should be around 30% of the entire portfolio. Moderate market exposure with stable income. Inflation protected securities, that is TIPS typically, should be around 15%. In a way protects against inflation risk. High quality corporate bonds around 10%. So it balances the yield with lower credit risk, and cash and liquid assets should be almost like 5%. So it addresses liquidity risk and market downturn. So this is the overall portfolio composition that every investor should ideally have, and this is all about the whole modern portfolio theory for a risk averse investor. So continuing with this, diversification and its role in risk reduction, justification based on risk factors. So interest rate risk, lower bond duration and mix of tips reduce sensitivity to the rate changes. Market risk diversification with bonds, equities and cash stabilizes volatility. Liquid inflation risk, tips hedge against risk inflation, and liquidity risk, cash holdings ensure accessibility in urgent situations. So this is how the risk factors can be in a way mitigated by such kind of a portfolio diversification or composition. Theoretical justification, so in a way risk return trade-off is achieved, portfolio optimizes returns with minimal risk. Modern portfolio theory therefore is diversification reduces unsystematic risk, and capital allocation line, that is CAL, ensures efficient allocation matching risk aversion levels. So this is what the theoretical justification to the diversification and its role in risk reduction is all about. In a way, to conclude, this balanced diversified portfolio ensures stable returns and minimize risk, and ideal for risk averse investors being seeking preservation of capital and steady growth. So with this, in a way, we come to an end of the session, and because as I said, the chapter is very small, 2-3 pager chapter is there, and thereafter at the end of the chapter there are few short question and answers and long question and answers that were covered. So in a way, just to have a recap, as my practice has been at the end of the session. In this session, in a way, we saw the fundamentals of valuation in relation to risk and return. We saw how Harry Markowitz for the first time quantified risk and used it in portfolio decision making, and thereby formulated the modern portfolio theory, that is MPT. He suggested identifying an optimal portfolio based on the risk return criteria, and assumptions were there typically that investors are risk averse, investors prefer high wealth due to greater consumption possibilities, and given two portfolios with similar risk or constant risk, the one with higher return should be preferred. The assumptions are central to investment valuation. Then we saw how return can be realized or expected, the rate of return formula, the expected return formula we saw. Then we saw the risks, so risk defined as the chance of deviation from expected return. Higher risk leads to higher expected return, measured using standard deviation, and more volatile assets have higher risk. Diversification of risk was the concept that we touched upon thereafter. Risk can be reduced by investing in multiple securities rather than one. An efficient market allows risk-averse investors to secure investments through diversification. So in a way, risk diversification tool or a model or a theory can be used for a risk-averse investor by bringing him into or using diversification theory and encouraging him to enter into the capital markets. Diversified portfolios includes equity, bonds, real estate, savings account, bullion, etc. So well balanced mix of various investments should be maintained in such diversified portfolios. Correlation is a correlation among investments affects the diversification benefits. Then we saw the types of risk. In that types of risk, we covered interest rate risk, market risk, inflation risk, business risk, financial risk, liquidity risk, systematic risk that are typically non-diversifiable risk or risks which are beyond control, and then unsystematic risks that which are diversifiable risks, which are firm specific risks and that can be reduced or can be controlled. So formula for unsystematic risk is total risk minus systematic risk. Then we saw beta. Beta is a measurement of systematic risk, that is the market related risk. It indicates stock sensitivity to the market changes. So beta of the overall market is 1, and in that case the relationship of a particular stock vis-a-vis 1 is what beta is. So covariance of stock and market divided by variance of market. So if A limited's beta is 0.6035, then it means that 40% less volatile than the S&P 500, which is the market trend. Limitations of beta are there, which is that they are based on historical values and tends to move towards market industry beta over time. Then with this we ended the chapter, or that's what the small chapter is all about, around 6 to 7 concepts per se. And thereafter I took up the various Q&As wherein we saw modern portfolio theory, its objective, assumptions, risk return trade-offs, diversification principle, what it means and how it helps in decision making. Thereafter the question number 2 covered types and role of risk in investments. So we saw again the types of risk, which are interest rate risk, market risk. So there are total 8 risks: interest rate risk, market risk, inflation risk, business risk, financial risk, liquidity risk, and systematic risk and unsystematic risk. Then we saw how risk in a way has a role in investment decision making. Thereafter we saw the various 4 risk reduction strategies, which involves risk diversification, then asset allocation, hedging strategies wherein derivatives instruments are used to hedge the risk, and again research and analysis as a strategy for risk reduction. Thereafter we went through the beta, that is the beta is the correlation of stock standard deviation vis-a-vis the market standard deviation. So correlation between stock and the market, and then we saw this how beta calculation is done. So point 53, beta indicates that the stock is less volatile than the market. Thereafter we covered the realized and expected returns. So realized returns are the actual returns received by an investor during the holding period. Expected returns are the projected returns an investor anticipates from an investment in the future. And the general equation for the rate of return, which is considered in the investment decision making, is R is equal to the rest of the formula. Then we touched upon Markowitz's portfolio theory, the assumptions and the relevance. The key assumptions which are there in the MPT, that is a modern portfolio theory, is that investors are risk averse, investors seek wealth maximization, asset returns follow a normal distribution, and investors base decisions on expected return and risk variance, so mean variance optimization. So, and last assumption is that no transaction costs or market frictions, which is the idealized market conditions. The relevance of these assumptions are that these assumptions guide portfolio optimization along the risk return trade-off. They help in diversification strategy and to minimize the risk. Though idealized, they provide a foundational framework for modern investment analysis. Then we saw the volatility as a risk of measure. So how volatile a particular scrip or a stock is vis-a-vis the during a particular time frame. So volatility represents the degree of price fluctuations over time in a trading series, and it has a significant role in risk measurement. Higher volatility indicates greater uncertainty and risk. So standard deviation in measuring risk, standard deviation quantifies the dispersion of returns from the mean, and the formula typically we saw. Interpretation wise, higher standard deviation means higher volatility and therefore higher the risk, and lower standard deviation means more stable returns and lower the risk. Importance and limitations of beta in investment decisions. Of course, in the importance of beta, it is a measurement of systematic risk It indicates the stock's volatility relative to the market. It guides investment decisions used in CAPM and in portfolio diversification. Then we saw through the limitations of beta. It has a historical dependence. It is market sensitivity. Ignores specific risk and fails in extreme market conditions like financial crisis or black swan events. Then we covered the portfolio selection in Markowitz theory, the decision rule that choose the portfolio with the higher expected return if the risk levels are the same. So in a way, these over a period of time have become principles also, investment principles also. And as if you are following Warren Buffett also is stressing upon these principles, and reasoning behind this choosing the portfolio with the higher expected return if the risk levels are same is that in a way it's a risk return trade-off. Higher return is preferable for the same risk. Investor behavior obviously assumes investors are risk averse and seek wealth maximization, and hence if the risk is constant then look for higher returns. That's what the logic is. Efficient frontier concept: optimal portfolios maximize returns for a given risk level. Conclusion: in a way, a rational investor will always prefer the higher return portfolio when risk is constant. So that's the normal investor behavior which is there. Then we saw the difference between systematic and unsystematic or versus unsystematic risk. Systematic risk is the non-diversifiable risk. We saw the definition, the causes which are beyond control of the firm, and more of microeconomic factors. Then we saw examples wherein examples of systematic risk involves global financial crisis affecting all stocks, interest rate hikes impacting the bond and equity markets, because bond and equity markets always are inversely related. So, and then pandemic disrupting the global economies. In terms of unsystematic risks, which are diversifiable risks and more firm specific risks that can be reduced through diversification. Causes are majorly the internal business factors like management decisions, product recalls or labor strikes. Examples: we saw a company CEO resigning and leading to stock volatility, a product failure causing financial losses for a firm, a factory shutdown due to a workers' strike. The key difference between the two: systematic risk is market-wide and non-diversifiable, and unsystematic risk is company-wise or company and industry-specific and diversifiable also. Then we covered the diversification and its role in risk reduction. So diversification is one of the risk reduction strategy, and diversification theory is spreading investment across in multiple assets to reduce overall risk. Objective wise, minimize the impact of individual asset fluctuations on portfolio performance. Concept wise, based on modern portfolio theory by Markowitz, impact of correlation on risk reduction we saw. So combining assets with low or negative correlation reduces the portfolio volatility. Application of diversification in investment portfolios lowers the unsystematic risk, firm specific risk, creates a more stable return profile. Does not eliminate systematic risk, market-wide risk. Example: a portfolio with stocks, bonds and commodities reduces overall volatility as compared to holding only stocks. Conclusion: effective diversification requires assets with low correlation and helps investors achieve better risk-adjusted returns. Then we saw the calculation of expected return and standard deviation and how these calculations are being done. The various steps involved in computing the deviation from expected return. Then the square of deviations as the second step. Third step, multiply the squared deviations with probabilities. And fourthly, compute standard deviation. So these were the final answers. We thereafter saw the formula for a portfolio expected return, how it works. The conclusion wise, portfolio return is weighted average of individual asset returns, and portfolio risk depends on the asset correlations and variances. Beta helps measure the market risk exposure and is crucial for risk adjusted return analysis. Thereafter we saw the evaluation of the popular statement that an investor should not keep all eggs in one basket. which predominantly we suggested diversification to reduce the risk in investments. We thereafter saw these implications in portfolio construction, so risk reduction and impact of correlation. So these were the implications of diversification in portfolio construction. Thereafter we covered the enhancing risk adjusted returns and limitations of the over diversification. So limitations of over diversification are diminishing returns, management complexities and systematic risks still exist. So conclusion wise, diversification is essential but should be strategic investing in negatively or weakly correlated assets. Balanced portfolio construction ensures both risk minimization and return optimization. Then we saw the risk adjusted portfolio for a risk averse investor, how portfolio composition should be. So low risk and diversified allocation, and this is how the composition should be ideally. Government bonds almost 40%, blue chip dividend stocks to the extent of 30%. So let's assume the investable surplus is of 10 crores and government bond should be 4 crores, blue chip dividend stock should be around 3 crores, inflation protected securities, that is TIPS, should be around 15%, that is 1.5 crores, high quality corporate bond should be around 1 crore, and cash and liquid assets should be around 50 lakhs. So all this adds up to around 10 crores. Then lastly we saw how justification based on risk factors, interest rate risk, lower bond duration and mix of tips reduces the sensitivity to rate changes. Market risk in a way can be dealt with by diversification with bonds, equities and cash stabilizes volatility. Inflation risk, tips hedge against it rising inflation, and liquidity risk, cash holdings ensure accessibility in urgent situations. Theoretical justification over here is that the risk return trade-off is achieved. Portfolio optimizes returns with minimal risk. Modern portfolio theory is all about diversification, reduces unsystematic risk, and capital allocation line, that is CAL, ensures efficient allocation matching the risk aversion level. So to conclude, this balanced diversified portfolio ensures stable returns with minimized risk, and this is ideal for risk averse investors seeking preservation of capital and steady growth. So with this, in a way we conclude today's session. It's almost 8:15 p.m. and therefore if at all you have any queries, Anu and Rakesh, maybe we can take it up, or else we can sign off for today's session. So any questions, doubt, inputs or that you have? Rakesh or Anu? Good to go? Thanks. Anu? Okay, fine. So we'll stop for the day, stop for the session. See you in the next session with the next chapter, which is about, let's see what is the chapter. So financial statement analysis, yeah. So the favorite topic of always management consultant or management accountant professional. Let's see what is stored in financial statement analysis, or FSA as we call it. Maybe in the next session we will cover this, and then we are left with one more chapter to conclude module 5. So overall the percentage of this module is 5% of weightage, because again, as you see, the chapters are very small and it's more of fundamentals of business valuation, and thereafter the rest of the modules will be taking up in the remaining sessions in a structured way. So as I go, as my style has been, one session, one chapter, that's how we have been together for almost 19-20 odd sessions now, and I guess you have been benefited up till now. So 50 plus 55% of the portion is getting completed maybe by the next 2 sessions. I hope you guys have started revising for your examinations, and so we can stop here, Anu. Any questions, doubt? I am unable to hear, maybe you can give a thumbs up. Fine. I guess she is not able to hear, but So we'll stop here. I am ending the session. Thank you. See you in the next session. Bye bye. Take care. Keep studying.